Thanks for joining. I'm very pleased to introduce Dr. Sameena Shah. She is the head of research at Thomson Reuters. She's built many of their machine learning and natural language processing systems and capabilities. Her background is machine learning. She has a PhD in neural networks, and she's going to be giving an awesome talk. So, welcome.
Right. Thank you very much. And the PhD was not on neural networks.
Oh, sorry.
Yes,
I
and
knew I was gonna mess it up.
But these days, neural networks are back in fashion, so we'll go with that.
All right.
All right, so thank you very much for coming here. I will be talking about, in general, the whole idea of using words in predictive models, especially for equities and commodities markets, with a specific case study of improving the predictability of oil using a Reuters news corpus. A lot of this work was actually done by Armina, who is a part of our team, and I'm supposed to introduce Armina as the future Eric Schmidt of technology, so welcome, Armina.
Thank you.
All right, so let's start by talking a little bit about what do people think about, is there any predictive power in words that we could start including in models? So how many people here do use text while creating quantitative models? Right? So sounds like not the majority. So we have 3 people here who say that they do use text, which is actually quite in line with, I think, how most of us would perceive the answer of this question to be. So traditionally, models have always included numeric information, so hard metrics, financial numbers, things of that nature. However, if you actually think about it clearly, if there's a news story about a pipeline outburst or some other major event, it is going to move markets. And when we start looking at things that are more on the commodities side, those are even more sentiment-driven or news-driven. So the whole idea was, can we start creating models and create a paradigm for how to include the impact of words? So we've actually done this work for a few years now, and I kind of divided this slide and the difference in words in these 3-4 broad categories. So SEC filings, in one way, if you think about it, they are what the companies are saying about themselves. News, what experts or what journalists are reporting on about companies, and then social media, what the general crowd is saying about companies. We have actually done research in all of these 3 facets, and I don't know if some of you or any of you were in my talk last year. So last year my talk was more about how we could create predictive signals from SEC filings and social media, and showed the power of predictive words in those data sets. This year I'm going to talk more about news, but not for equities, but for commodity, because news, I think, a lot of people have started using for equities markets. So as a quick FYI, our results on SEC filings and social media were very, very phenomenal. Actually, one of our papers on the impact of extracting good recommenders from social media and using them for creating strategies won the Best Paper Award at a top social computing conference. So this, after we conducted all of our research, our business units in commodities, they kind of came to us and said, hey, can you create some model for us? Our markets are even more sentiment driven and even more news impacts those markets. So of course, we would say yes, because that's an interesting premise. Let's talk a little bit about the commodities markets first, because there are fundamentally a couple of differences in the commodities markets in comparison to equities markets. One, like I've alluded to, it's even more sentiment and soft metric driven than hard metric driven compared to equities markets. And then secondly, the amount of, I want to say, technology or quantitative models or the complexity of models that are being used in equity markets now is far ahead of what's being used in commodity markets. And intuitively, like we were just talking about, pipeline gets attacked, of course it's going to move markets if it's a significant one. So how do we go about using that intuition and creating a quantitative model that would allow us to capture that impact of the event and then turn it into a predictive model. So we have to step back a little bit and first think about what is it that actually moves markets. And the second thing that's interesting about oil markets is they don't trade as much on spot markets as mostly it's all futures. And CLC1 is the first 1 month forward contracts that are the most often used, and CLC2 the second most often used. So all the research I'll be showing today is based on CLC1 and CLC2. So if we think about the oil markets and what moves them, one of the significant things that may or may not be intuitive is that timing is actually quite important. And so things like inventory numbers, they always get released on a Wednesday. So there's an effect of that Wednesday there. So the actual timing of when information was released, that could be something significant. Then secondly, what is the event? Pipeline burst or whatever, some like war in Middle East, those types of events, they could move markets. And then from news, not only do we want to capture that headline of the event, we also want to capture the narration behind it. Because different pipelines could have wildly different effects. So we do want to capture that whole narration and that reporting or journalism, that what the journalists thought the impact would be, and try to capture that nuances also from news stories. And then there's this also very interesting thing which I think also is happening in the equities market is bad news comes out, the effect that happens is dependent on what the market mood was. The same story when people were already optimistic or when people were already pessimistic could have very wildly different effects. And similarly, if the momentum was in a particular direction and the same story came out when it was kind of going up versus kind of going down, it could have different effects. So we did want to capture that as well. So when people think of words, now this is my hypothesis which is based on empirical evidence, the first thing they start thinking about is sentiment. And sentiment is kind of what? It's kind of saying that, oh, I have these mood words or some other metrics that, and then these are the words that I'm going to use this mapping for. So this particular word would map to positive, or this would map to fear, or those types of things. And then I'm going to create this sentiment engine and use that index kind of to figure out, or that factor to kind of figure out how things are. That's a valid approach, and we do have a product, tRNA, that kind of already does that. So we wanted to do something much more than that. So the second thing that people start thinking about is maybe you don't have that mapping, because that would be a flaw, that if you have those hard-coded mappings or even not hard-coded ones, you're still mapping to a fixed set of things, and that may not be capturing all the nuances. So another very common NLP approach is to start using bag of words, which is possibly the simplest of approaches that you could have. And so one of our colleagues, a couple of our colleagues, they started working with bag of words approach. And the good thing about a bag of word approach is it's very simple to implement, and it's very intuitive. And instead of just having a mapping, you could have some kind of aspect about each word. So how does bag of words work? So the idea being that if this is your vocabulary, and you have to come up with a fixed vocabulary beforehand, and then this is your news story, then you represent your vector as an attribute on each of your vocabulary index. And then this, the word this is not, so if this is bag, so the word bag does not exist in this thing, so it's a 0. If off is not existing in the story, it's a 0. The word words does exist, so it's a 1. Oil does exist, so it's a 1. So you automatically already see that this approach is also slightly flawed, because you're not capturing all the words. You are dependent on your vocabulary, and then the other problem being you're not capturing anything like synonyms or hypernyms or anything of that type of relations that exist between words. So spoiler alert, it did not work. It did not reach the baseline. And I'll talk about our baseline, but the key idea here being that if you were to use this type of approach to model news versus not use them, you would be better off not using news in this way. So, yes.
When you say it didn't work, do you have a specific predictive timeline? Like, is it 1 day return, 1 week return? Or?
Yes, so that's a very good question. So we were trying to do intraday, 90 minutes ahead. As soon as the story came out, could we guess what would happen 90 minutes ahead? And then the second learning that came out was that regression is actually pretty bad in high dimensions. So we then also started thinking about other ways of kind of reducing the dimension and approaching it that way. Another learning which came out was that not all news stories are actually meaningful. So when we started looking at the output that our colleagues had created, we realized that there were some words in there which didn't make any sense. And then we kind of had to reverse engineer and figure out why those problems were happening. And I'll talk about how we ended up choosing the good stories, the good news stories that are actually meaningful and should be included in models. This idea about the high dimensionality space was again a significant one, and I'll talk about that. Yes?
When you, on top of the not all stories are meaningful, do you also separate between the outlets? Because some outlets I find, like having worked before in a bank, like some outlets have for some reason periods where they're actually, the market just seems to follow them versus not. And it's just an intuition of watching it versus, but I never tested it quantitatively. But have you tried like ranking between outlets?
Yeah, I'm going to say something which will make you very suspect, but it is true. We ended up using Reuters corpus plus more, and then only Reuters was the best.
How did you pick the 90-minute window, given that it seems like at least, like oftentimes, like the very second a story hits, the bulk of the price change happens?
Yes, that's a very good question. So there was no reasoning behind choosing 90 minutes. It was just a random number, and just something that we thought we could start with. And then our key hypothesis in doing all of this is that if there is predictive power in these words, they should work in any predictive power or whatever. The idea being that whether including those words or not including those words, including words should be better than not including them. So it could be 90 minutes ahead, it could be 10 minutes ahead, whatever you want, you could choose that.
But you're just looking at like trying to predict up or down, like
Yes, directionally,
okay.
yes. So we're not saying that 90 minutes ahead was the best thing that we found, that this would be the best thing and that's what you should do. I'm not saying that at all. This was just the one thing that we tried. It's not a tuned number, I guess that's what I'm saying, yes.
Did you build a supervised set so that you knew that, following on this question, like if you were to just read the stories and you knew that it was the words were basically negative and second was up, did you see the price always went down or always up? How often was the actual result counterintuitive?
Yeah, so I'll talk about that a little bit.
Right.
And maybe not exactly your question, but a little bit, and we'll touch again on that question. So great segue. So one of the other aims of our project was to not come up with a black box. It was a requirement that we create a model that could be understood by human domain experts, and because this would be used by our analysts in the commodities business, and the idea was that this should aid their understanding, and it should not be like 0.25 or 0.98 that they have no idea why that 0.25 or 98 came from. So a key thing was that these models should be human understood. So one of the things that they initially told us was that we do know there are certain words that do affect oil in certain ways, and can you start with looking at those words? So our head of commodities reporting, Jonathan Lev, we met with him and he gave us the set of words that he thought were very significant for the commodities business, and then these could be words that always, if present in news, could have an effect. And so what we did was, instead of looking at all bag of words, we created a model with just these words and saw their effect. It wasn't that great. We moved on. So our approach was using an LDA-based approach, and I think many people would be familiar with LDA, which is basically a standard approach in natural language processing, in which you come up with a set of documents, and it automatically clusters words together so that words that are always arising in the same context are grouped together, and they are separated from other words that are not arising in the same context. So I'll give you an example of that. So our LDA models, when trained on news, were then able to identify that words that have been highlighted here in green are words that are associated with the government topic, and words that are blue are kind of in the journalism cluster, and words that are in red are kind of in the oil accidents cluster. So that once you get these clusters of words, you could then score a news story on how many and what percentage of topics is present in each news story. So then once we got this corpus of LDA topics across a 12-month period, we then tested each story for what was the topic mixture distribution for each news story, and then aggregated all of them within 1 minute. All the news stories that were coming out within 1 minute, aggregate them, and create the model distribution for them. Then we created two models. One is our baseline model, and the other one is our hypotheses model. And then the idea for the baseline model and the hypotheses model is that the only difference between them is the presence of the LDA topics. So the other, and the baseline model is then, the calendar effects that we were talking about, which do play a role in the commodities business. Then momentum, because we do want to capture what was the market state and the people's kind of mood when the news story came out. And then the hypothesis model includes calendar effects, momentum, and the news ones. So if there was a news story that came out at, let's say, this time, then we would kind of have a dummy variable to denote that which was the day of the month when it came out, a dummy variable to associate day of the week, hour, minute, and then the actual cumulative returns for momentum and log volatility. Sorry. Yes. And then just a reminder that the LDA model are the topic distributions. And then the idea here was that let's say we are predicting at time 10:15 a.m., then we would be using the log volatility and cumulative returns at 9:15 and 10:05. Sorry, 10:10, 5 minutes before. This is a typo. And then similarly for each time. And then this would be the baseline model that only uses the calendar effects as well as momentum, and our model uses both of these as well as the news topic distribution. Just to give you a highlight of the kinds of topics that we actually did discover. So these are three of the sample topics, and you'll see these numbers. These numbers are associating the probability of each word in that topic. And you'll notice that these words kind of look funny. They don't look like proper words. It's because we stemmed words. So you could use whatever stemmer you're interested in. And then you'll also see words like this, energy_sector hashtag, because we did not want proper nouns, people's names, companies' names, to be included in our topic models. So we masked them out by using common words, this masking them with these common words. For example, if there was a company that belonged to the energy sector, we would mask it by using this word. If there was actually a person name, we would mask it by a hashtag mask or something, hashtag person.
Did you keep them separate? If there was two companies in the energy sector, was there energy sector 1 and 0, or you just mushed them all into
Yes.
energy sector company?
Yes, we did not separate them. Because one of the things that we wanted purposely was that this model should not be overtrained for specific periods of time, because at that time a person or a company might be having a very significant role in that time period, but we did not want the model to learn that transient thing. We wanted it to be an effect, a general effect that we wanted to capture. And as you'll notice, these are pretty good. The Middle East political unrest one kind of talks about those types of things. Oil shipping kind of talks about those types of words. So these are reflecting the kind of theme that's going on. Now, one more thing which we found to be quite useful was smoothing. So remember I said that we are aggregating information per minute, but sometimes what happens is that becomes too discrete. So when you start training your model, and let's take this example. Let's hypothetically assume that this was an accident one, and there were suddenly a lot of reports about talking about accidents, and then maybe for a while there were no reports about that. But you can't really assume that that effect has gone away. You want to smooth it out, so because that effect is going to last till some point ahead. So, and we did find that smoothing out these topic probabilities did play a good role in improving our predictive power. Now, this is the third thing that we found to be very useful. So when you look at news stories, there are different types of news stories. The first one is what we are calling the price updates. There's no real information here from a textual point of view. It's mostly reporting on things that have already happened. So it's not useful for our context. Then the second one is what we're calling the top headlines. Again, nothing new is happening in this story at that moment. It's aggregating all the top headlines that have already happened in the recent past. Then there could be non-English. We stuck only to English stories. And then this would be an example of a good story, the type of story that we are interested in using. And again, it's easy to code rules to figure out what the story type is and to eliminate that type. For example, I mean, if you're interested in a rule, this one of the rules you could use for this one is the proportion of numbers or proportion of price type of data. All right, so then when you look at even a single story, which is a good candidate for a story, then not all of the words in that story are going to be meaningful. There is definitely boilerplate text that exists. At the end, you'll see that, oh, this is Reuters news, this is this person, find me at this, hashtag, whatever, those types of things has nothing to do with the story. And then similarly, in the beginning, you will see some things. So you kind of have to figure that out, that what is the boilerplate text, get rid of that. Then we did find that stemming and then dictionary check, which was a non-intuitive one for me at least, that they would be non-English or those type of words in stories, but apparently using the dictionary check also is useful. And then removing stop words, because stop words usually do not have predictive power. So stop words are words like articles, propositions that don't really have any predictive power in themselves. So there are libraries that have like lexicons of stop words, so you can just identify and remove them. And then we replaced company names with their sector, and we removed the names of people and location. Now, location is one that some people might argue that actually some locations are universally important and they will continue to be. So it's up to you whether you want to include them or not. For our purposes, we did not. And then so once we did all of that filtering and all of that cleaning and created the topic models based on that clean text, we used those to predict 90 minutes ahead. And we used a very simple model, ordinary least squares, to try to do that prediction task. Again, the idea was not to come up with the best trading strategy. The idea was just to see if there is predictive power in words, and that improves the baseline model or not. Once we started doing that, we saw that it was improving, but in general, whenever one does prediction, I'm always a fan of when classifiers output a probability versus a binary score, because classifiers are not always very confident on what it should be. So we use the probability score of what the classifier thought the number should be, and if the probability was kind of in the region that the classifier didn't seem to be too convinced of what it should be, it was in the boundary region between the two sides, then we rejected that. And we did not follow the advice of the classifier or the predictive model in that instance. And then, so that actually improved our accurate predictive power. Now, one more thing which Andrew, who was the person who was working on this, found was that this threshold was quite interesting. If you use a static threshold, you would get some predictive power. But if you use a dynamic one, that seemed to improve the model quite a bit. So if the model got it wrong, and it was kind of had a high enough score, then we would actually use a wider threshold window. And if the model got it right and we had not used that, then we would reduce the threshold window to actually start accepting the model's output even more.
So you were training your model after you trained your model?
Yes.
And this was
So it's not the model that we are training. I mean, in a way you could say that, but it's really just a threshold. It's our confidence in the model. If we think the model's getting wrong, we are not accepting it.
What were you using for supervision to make that decision?
Oh, it's just a retrospective one. That in the last 5 days, our model is always getting wrong and something's not off. So we are not going to accept and make a prediction or like bet and the model is saying like 0.65. We are going to accept the model only when it's 0.75. And if the model is kind of getting it right, and our threshold was 0.65, and the model is consistently right, we know that the model is working really well, so we reduce it to 0.5 and start accepting the probabilities even when they are 0.55 or 0.6. Yes?
So you're predicting sometime ahead, 90 minutes, yeah. So how does that, at every point in time, you're predicting 90 minutes ahead, whether it goes up or down?
Yes.
From the point that it's at?
Yes.
Okay. So yeah.
Yes.
Just to clarify, you're not just trying to predict the 90 minutes after the Wednesday
No,
US petroleum.
it's always.
It's always.
The Wednesday thing is only because commodity markets, there is some information that's released always on Wednesdays, and then we were kind of thinking that there could be other news stories that maybe come out only on specific days. So we wanted to capture if there are any other time effects like that. So it turned out that, and then there are the famous things that with news that bad news always gets released on Friday at 4 and those types of things. So we wanted to see if there are those day effects or time effects, hour effects, things like that. And it turns out that our weight analysis shows that there is some significance to day of the month, day of the week, and hour. Hour seems to be even more significant. So things come out early in the day versus late in the day, so on and so forth. However, momentum features play the majority of the role. And then the topic weights, again, were very significant. And this is just a sorted one, which is trying to show that topic weights that had the most negative correlation, as in the prices would actually go up because commodities work the other way. This one was the most negative one, were these, that if there was about output or there was about exporting or their oil supply was boosted, then it would actually cause a dip. And then if there was about market rising or there was increase or there was some talk about costs and things like that, then it actually the futures prices would go up. And this is just kind of showing that some of these topics didn't have any significant features attached, but majority of them, as you can see, had a big correlation. Thank you, Armina, for this chart. So this is kind of our predictive power on the 2011 data month-wise. This is the average accuracy of the baseline model, which is without the news-based models, and this is the news-based model, which is significantly higher than the baseline model. And then we did an interesting experiment. We said, what if we use the same 2011 data to make a prediction for 2015, and we don't update it in the meantime? As you'll see, the performance of both the model drop very significantly. However, it's interesting to note that the news-based one did not drop as significantly as the other one, which actually was counterintuitive for me, because I was thinking that in news, more transient things would be expressed as compared to momentum and other things, but it turns out that that was not the case. Now, of course, nobody would actually use 2011 model for 2015. You would keep retraining, which is what we did, that we always used a rolling 12-month back corpus of news stories to create topic models on. And if we were to do that approach, then in 2015, we had a 54.9, very similar to the previous one, and then the baseline model was not as good. So there are fundamental changes in how the time effects are playing the role. Yes?
When you say you used 12 months back, so have you seen a change in, like, obviously the past 2 years are very bearish, a lot more news versus earlier in 2010, 2011, you can argue still there's upside, super see a change across the years in the type of, or the density of the use case?
Yes. So not as much as in the density, but there's more effect on one, like how the oil markets were behaving in those periods. And my next slide is about that topic. Yes.
When you say accuracy, this is like when you say up.
Yes,
the
directional
percent goes
accuracy.
up.
Yeah.
So, but if the accuracy was 0, then that would mean it would always be wrong, which is the same as 100% accuracy. Because
Which
if
is
it's
the
always
same as
wrong,
100.
then you do the opposite. So isn't the worst case scenario 50%? I mean, because you didn't separate
Yes,
false
the
positives.
worst. Yes, the worst one is
So-
50%.
So if this thing drops to 37%, like that's better than 50%.
Yeah.
Like if you know it's, so I'm kind of confused by what this means.
So accuracy and these things are more used in the NLP machine learning world. So I understand your confusion with that, but
Well, like I understand accuracy predicting a specific number, but if you're going like this matched or it didn't match, then you need to talk about false positive, false negative,
Yes.
true positive, true negative, because I
yes,
mean that's what's actually meaningful.
Yes.
Like,
Yes.
I would expect like 50% baseline. That looks like perfectly worthless.
yeah, that's a totally random strategy.
No, but perfectly.
Yes.
Yeah, but if it goes down to 30 or up to 70, that I mean.
So
like-
here's the thing. Theoretically, yes, and I always like to say whenever we got numbers like that, oh, now we just need to do a 1 minus. But those things you discover in retrospect when you've already lost the money. So you can't be switching things and like after you've lost the money and you're kind of at 30% accuracy, because that's what I think is overtraining or like hacky science or whatever.
Yeah.
I mean, those things have to, your hypothesis, it's whether your hypothesis is making sense at the end, or if it doesn't, it's going opposite, and I think you should discard that.
Yeah,
Yeah.
may I add something?
Yeah, sure.
It's not just about precision, it's also about robustness. And I think that's the point that this slide tries to make. Because if you by chance find a model that's so bad that it actually is good, then you can't be sure that it acts robustly if the market situation changes. For instance, with regards to the oversupply crisis of early 2014 and 15. You want to have confidence as well as precision. You want to be able to explain what your model is really doing, which I think is the point that the slide will try and make.
So
Well,
it's
also like for the 2011 numbers, like you tuned your model with the parameters based on the data set in 2011,
yes,
right? And then you're looking at the accuracy based on 2011. So when you added the language data, you've added an extra parameter to your model, like a whole bunch of other things. So you're giving it more parameters to fit. So I would be surprised if it didn't become more accurate, because a more complicated model can always fit the data better that you're actually testing on.
that's wrong. If just going by that hypothesis that you throw in more data, you are going to become more accurate is a flawed hypothesis.
Well, if you're just overfitting, I mean, you can always, I mean, if you give it
Overfitting has
enough
nothing to do
parameters-
with it. I mean, if your data is wrong, does not have predictive power. If I give you the birth weight of monkeys and you put that data, why should it have any effect? If it does, it should not. So my point here being that if something is coming and you say, oh, this birth weight of monkeys is now giving me 25, I'll just do 1 minus 0.25 and that will give me 75% directional accuracy, and that's great. That's wrong.
No,
But
well, I'm
you
not
did
really
have a
saying that.
robust model in the negative, because what you could have done is simply treat it as a volatility model and say that with those words, maybe you're getting the wrong direction, right? But the mere fact that you have significant value in them means that when people see this news, something's going to change. Trying to predict up and down is wrong, but volatility was going up both times, right?
So our volatility, we actually did do a volatility prediction as well, and in that the baseline model was greater than 50% accurate.
Mhm.
So I don't know how,
And then the word
but
model.
that was slightly more than the baseline model. I have those numbers
Okay.
here.
Oh, interesting.
Yeah.
And your volatility model, though, wasn't simply putting an absolute value around the first one?
No. So here's the thing that Armina was trying to raise, that it's also about robustness of your model. So let's say it was 0.35, and you took with that, and then it started, again, was being wrong, because you fundamentally don't understand how the model works. It was fundamentally not subscribing to your hypothesis. you kind of still went with it, but it now just stopped working. So here's the thing, like there was a change in the oil markets with the global oversupply in late 2014 and early 2015. And we saw then periods like these, that there were sharp declines and there was slow recovery. Now, akin to this is, I'll give you a situation from the machine learning world. Let's say your classifier model has data which is 99% one class and 1% the other class. And you create a model that's saying that always 100% go with there. Is that a good model? It's not. It's a very bad model. So your model should also be good in both the classes. It should really try to capture that instead of being a dumb model that always predicts one way. And so that's what we try to capture with this, F-score and how it's doing in each class. You use kappa statistic to also capture how it's doing in each class and kind of go with that comprehensive understanding of what really your model is doing, instead of just based on a couple of numbers, right? All right, so in conclusion, I think we did beat the baseline, and our second biggest requirement, apart from beating the baseline, was that the topics should be intuitive and should actually be understood by people as opposed to black boxes that make no sense. So our topic models that we showed to our analysts, they're kind of happy with that because they do seem to make sense. A couple of examples I showed. And then some of the lessons learned along the way was that you cannot be using news just as plug and play. There's a lot of work that needs to happen in kind of recognizing which news stories you need to pick. And then even when you start using a news story, then you have to figure out what's boilerplate and not predictive and use the actual predictive parts. This work was a team effort, and a lot of people contributed to it, actually. All right, thank you very much.
Publish this model to your data feed? Were traders getting this output?
No. This is only to help our internal analysts. We have created a dashboard. This is not my computer.
So how are you going to measure the feedback effect? If you're publishing this to your analysts, if your analysts believe it and start forming their opinions based on the signal, and then traders start trading on that opinion, don't you end up in a very self-fulfilling environment?
So here's the thing about these models, and that was, again, that's a very good point. And that's why we were always asked to create models that would aid understanding and not give them final numbers that came from, the machine has spoken.
And
yes.
lowers liability.
And just one last thing. So these models actually, and the true test is out of sample. So they have been in production and they have been running for over a year now. And we are seeing the same types of accuracy that we were seeing in our back tests and other things. So it's out of sample is working well for over a year now.
Do you have any immediate future directions? Because I can see that being applied in a few ways. Like you focus on the first two contracts on the futures curve, but obviously you can go out and maybe see the effects there. And also seeing as not just within 90 minutes or even days or months, but obviously 2010 to 2014 is sort of like this, you still had a pretty good commodities price, environment, and we entered obviously a bear market. So I guess you could have sort of a two-tier or multiple hierarchy of general, maybe not sentiment, but news effects, where short term it's very range bound. News has shifted upward one way or another, or in other periods it's very it sort of has its own form of momentum. So do you have any future?
Yeah, that's a great question. Yeah, we haven't looked at that, to be honest with you, but I think that's a great question, and one could get better if one starts modeling that effect.
Have you tried word embeddings?
Yes, we started playing around with word embeddings last year. Armina actually has a paper, not published yet, in which we looked at how news was changing over decades and how the meaning of words has changed over time. So we haven't used it for this type of model till now, but we're kind of studying how news is changing over time. More like an understanding of news.
course would sound like a logical, extension of what you were doing with this word buckets.
Yeah. Definitely.
So I think we're out of time for now. If you guys have more questions, I would encourage you to carry your discussion after this session. You guys have about 10 minutes to move on to your next workstation, or you can stay here. But yeah, you guys are kind of free to roam about now.
All right. Thank you very much.
Thank you.